Time now to dissect our topic of the week. The local listed property space in South Africa consists of 25 different counters. Each of these consists of various degrees of commercial, industrial and retail space. The basic premise of property is simple. A physical building which is rented to tenants whose rental acts as income for property owners. Listed property portfolios consist of many buildings which are divided into units or shares on the stock exchange, allowing for public participation. How do professional portfolio asset managers choose amongst the various listed instruments, and how do they build a portfolio? Gentlemen, welcome to the program. Great to have you on. Cool, let's start off with you. In fact, the property sector as a whole so far this year has outperformed all asset classes, so doing quite well relative to the benign numbers that we see and returns that we see on the JSE.
I mean, property, not only this year, but if you look back over the decade and so on, has been in a serious sweet spot. I mean, let's just look at the first graph there. And I mean, as a matter of fact, we've upgraded our graphs on the show. Afterwards, we'll give you our email address. Please tell us what you think of the new graph format. If you have a look there on your screen, you'll see SA listed property and what the returns look like for the sector. And you'll see on the blue line indicates a rolling 12-month return, whereas rolling 3 years is the maroon line, and then green is rolling 5-year returns. And you can see that there's as much, if there's volatility in this asset class because it's a growth asset class. So if you look at the rolling 12-month numbers, you can see that there's volatility in this asset class. There's chances that you could make 125% over any 12 months. Yes, it's definitely possible, but then it's equally possible to potentially lose money in this sector as well. Once you own it over longer periods of time, you obviously see a far more less volatile picture kind of emerging. And I kind of want to hone in, if you look at from the late 1990s, let's call it 2000, and if you look at those kind of numbers, you can see there's massive run up in property returns, and that's because we kind of set at these very, very high yields for property as it continued to squeeze down. And that's, Eleni, by the way, what you're talking about. We continue to see a run in property as far as that's concerned. To give you an indication, average return in property over the long term, 19% per annum, whereas South African equities, for far more risk, kind of gives you about 15%.
You know what I find fascinating? Listed property is doing quite well, but when we see what is happening on the ground, there's a bit of a disconnect, Roland. Why are we seeing this disconnect?
Well, I think we're at a bit of a cusp, and maybe Paul can jump in here and give us his feedback in terms of what he currently thinks of it. But, we're at this point where we are in a situation where inflation a couple of months ago was rearing its ugly head, and we're now in a situation where we're worried about slowing growth. In other words, interest rates might stay lower for longer. Property, when inflation surprises, and the same goes for equity and bonds, don't do well in that situation. In the long run, property is an inflation hedge, but it's at these turning points where it can really surprise us. So I don't know what, Paul, your view is at the moment on the situation.
Issue about the disconnect. I think there is definitely a lag between what we see happening in the direct market and how it gets captured in listed property income streams. You've got to remember that a listed property lease really only markets to market every 3 to 5 years on average. That's the average lease term in the market out there. So if market is exceptionally weak today, you may only capture that marking to market exercise in 3 years' time. So what's happening now, if market is flat for the next 3 years and underlying lease contracts are escalating by 8% from this point on, in 3 years' time when you come to renew, that's when you capture the over-rented situation, not today. And I think exactly what you're saying as well, Roland, in the short term, the volatility is very much driven by capital market movement, expectations around inflation, short-term rates, that type of thing, and obviously the correlation to the 10-year bond is very, very high, so as that moves, property yields move with it. But over the long term, your total return is very much driven by your income and then your growth in income over that time, which is very much inflationary.
Okay, Paul, give us a sense in terms of what investors out there should be doing with regards to buying into the listed property space and getting exposure to the property market relative to some of the instruments and, of course, to the methodology on the market, or whether they should just buy an asset, a property on its own, and allow that to appreciate over time. And I suppose the easy answer to that is that you get more diversification when you get involved in the listed property space. But what are the other benefits?
Look, I think the risk is obviously buying an individual asset. You have a lot of concentration risk, and you don't have that diversification. Whereas buying a listed vehicle, you're getting diversification of many assets as well as a good asset management team running that portfolio. The reality is as well is I think that property going forward is not likely to do the same kind of returns that it has done over the last sort of 5 to 7 years. So I think investors need to be realistic about their expectations. In our view, property over the long term is really a 12 to 14% asset class but you can have a lot more volatility in the short term, really driven by capital market movements. So these sort of 18-19% that we've seen historically, unlikely to be repeated, really driven by less probability of a re-rating in the yield, and also the fact that we are in a lower growth environment than we have been over the last few years.
Paul, maybe just a question quickly from me. I mean, all listed property consists of retail, industrial and commercial property, all to greater or lesser extents. Give us an indication. You receive a cash pile today from an investor. Let's assume it's an institutional mandate worth 100 million or 50 million, and you've got to build a brand new portfolio. What are the kind of characteristics that you take into consideration? What are the kind of considerations? What do you guys think about when you do this?
Look, obviously, I mean, the reality is that you're looking for a company that's providing a return that compensates you for the risk for investing in that particular asset or real estate company. And every real estate company is different and will have exposures to different types of the market and will have different rental levels in their portfolio. And really, the most important thing is obviously understanding where we are in the cycle. So, for example, right now, retail will dominant, good quality retail will be more resilient in the current environment, whereas offices are under significant pressure because we're not seeing significant growth and net absorption in office space, and we've got a lot of oversupply. So that's one sector you would typically avoid at a generic level, whereas dominant regional is looking reasonably resilient. I wouldn't say it's going to shoot the lights out, a lot more defensive though. But again, you need to differentiate between different types of retail. At a portfolio level, you're looking at things like their rental level, like where are rents on their portfolio relative to markets. In other words, when those review cycles happen, and typically every year you have approximately 20% of your portfolio renewing or being renegotiated, all of those rentals are going to be going upwards or downwards based on where market is compared to where lease expiries are. The other factor is obviously costs. A lot of these guys are listed companies are battling with electricity tariff increases, rate tariff increases, and although some of the rental contracts allow them to recoup these costs from their tenants, it does impact the affordability of tenants going forward. So that's another factor you would look at a company-specific level. And then finally, it's their balance sheet. It's what is their debt looking like. The same factors are applied. You look at where their debt tranches are expiring, at what interest rates they've previously fixed at, and if they were to roll over that debt, will the cost of funding on that particular tranche be going upwards or downwards? And that all flows through then ultimately to the income that we expect that company to pay out. Obviously, every company will be different. And we'll look very much at a bottom-up analysis, looking at all the companies right through the sector, and obviously we are looking for a return expectation that compensates us for the individual risk that we see in that individual counter as well.
Paul, can I jump in here and just ask you, in the last few years, I guess there's been some competition for, let's call it property asset managers, in the sense that there are other asset classes that have come along, things like pref shares, and to some extent the whole inflation-linked kind of environment, and especially now at this cusp period where we have perhaps inflation, eventually coming through, and inflation-linked sort of bonds might be seen as a proxy or as an alternative. Do you see any of that in terms of the flows in your business?
Yeah, I think one thing we definitely do see very much on the institutional space is that traditionally a lot of retirement fund type portfolios and institutional type portfolios have been underweight property as an asset class. They've typically allowed the property allocation to be made by the income manager or the equity manager, and historically those managers have tended to be underweight that asset class because they haven't felt comfortable with it. And we're definitely seeing now an increase in a specific allocation of at least 5 or 10% in those type of portfolios, but still possibly allowing the enhanced component of the allocation with maybe the equity manager or the income manager, but rather to have a core component to compensate them for or to give them the sort of diversification and income enhancement benefits that property does, as well as that inflation hedge over time.
Well, Paul, you alluded to some of the yields that we could see in the market. What kind of numbers are you alluding to right now? I know that I've even heard numbers of between, say, 6 and 10% in the property market. And when you look at the bond market in South Africa, if you look at the long-term bonds, the 10-year bond, we're sitting at a yield of around 8.1% or so. The differential is not that massive. Why would investors then opt for getting exposure into the property market if you could just buy a bond in South Africa?
I think the difference obviously is that when you buy a vanilla bond, you get your coupon till maturity, and that coupon is fixed. Property companies have the ability to grow their coupon or their income payout. So effectively you're getting a yield on par or hopefully at a slight premium at initial investment, plus you're getting the potential for growth in that income over time. And it's that growth in income over time that will ultimately drive the capital value appreciation. You know, when bond yields do move out, property yields tend to move with them, but over the longer term, the capital value appreciation driven by that income growth does provide a certain hedge against that derate in the yield.
Yeah, I mean, I think, you know what's the most important thing here is that if you look at property just from an asset allocation perspective and you try and utilize the yields and the kind of returns that we've seen over the last decade as far as this asset class is concerned, you're going to get to muddled numbers because the returns come in way heavier than equities. You know, the volatilities look so much better. So if you're optimizing and you believe in optimization, you just use some quant techniques, it'll just favor property on a continuous basis. So certainly you want to kind of taper those numbers, and I mean, I think that's really important. I mean, Paul, one of the things that kind of that strikes me is just the number of listings that we're starting to see coming to the market on the property side. We've certainly seen, because there's been such great returns, do you think this is now attracting a whole bunch of listings that are maybe subpar quality, or do you think they have similar quality to what we've seen before?
I think they're definitely on the same quality of what we currently have, and you know, by way of example, of the 6 new listings that have come to market, we've only supported one of them, and that's an indication of the fact that, you know, we don't think that the pricing which they came to the market at was justified for the offering that they came to the market with. There was nothing unique about them. You know, they were effectively taking advantage of the market's appetite for variety and new listings, and on that basis we're able to get very attractive pricing. Our view was that there wasn't the return expectation that we had for those counters didn't justify the risk that we saw in them. And you know, new listings of that sort of nature, one must, you know, put it out there. This is top of the market type behavior at the back of a 30% return in 2010. I think a lot of promoters saw it as an opportunity to sell their portfolios into a market that had the most appetite.
Yeah. Okay, so Roland, let's get a sense from you with regards to how it affects the risk in your portfolio. Does it help reduce risk? Does it increase risk when you have exposure to the property market?
I think property is, from a risk perspective, something you've got to hold for the longer term. You are just, by doing that, also postponing when you need to get out of property. And getting out of property is probably the biggest risk, especially if it's sort of private property or it tends to be quite illiquid. So I think that is the biggest kind of situation in the short term. When somebody's trying to redeem their holdings in these companies, there isn't necessarily enough liquidity. Our property index and sector is certainly growing, and there are more companies coming to market, which is good. But I think illiquidity is probably the biggest concern around property.
Kobe, you're talking about a lot of companies coming to the fore and listing on the JSE, and of course when we saw the crisis in 2008 it didn't hit us nearly as hard as what we saw coming through in the developed market. But with regards to getting exposure right now, you've also got to see what is happening on the ground, and Paul alluded to it a little earlier with regards to tariff increases, electricity increases. We know that rental estimates are starting to come down in some instances. We still see vacancies relatively high. How linked is it for you in terms of what is happening on the ground? You've got to look at it case by case basis. Yeah,
I mean, that's why I say the expectations that you have for this asset class, you have to taper. So you have to become realistic about these things, rather than saying, and I see a lot of investors doing that, saying, well, you know, I own a property, or I've owned a property, a loan stock or a unit trust, which is similar to the REIT in the international space. And you know what, I've done such fantastic numbers in the past, and I'm just going to carry on owning this thing because I think I'll do as well into the future. And I think one has to taper those expectations, because at the end of the day, property prices like any growth asset class. Yeah. It's got an asset base, it's got an income, and you've got to understand the relationship between those and kind of the factors that are kind of squeezing on this on a continuous basis. And I mean, and that's Paul's job at the end of the day. I mean, Paul is trying to take the 25 counters that are in this country and internationally through the international funds. They're trying to take the funds that are internationally listed, the REITs, and they're saying which ones are the best to buy, which offer the best kind of combination of these.
Okay, so Paul, let's also perhaps get your view on the likes of the risk within the sector. Bankruptcy, is that an issue for you down the line? I'm sure you look at these companies quite extensively. And property syndication, we know that's perhaps sometimes viewed in a negative light. Is it as negative as the market makes it out to be, or do you think that it is a positive within the market?
Look, to be honest, we would never consider investing in a property syndication. I'm not an expert on them, but I think generally the ones that I have asked to look at on behalf of people that typically want to get out of them is that you know the prices at which they get you know inserted into or get syndicated at is typically way above market, and you know that typically what happens is that portion of the The capital purchase that is made by the investors is held in a sort of provisional pool to top up the income for the first 2 or 3 years, and at the end of that period the property is stand on its own. But very often what happens is the yield that was propped up for the first 2 or 3 years may not be sustainable at the end of that sort of guarantee period, and sometimes the income comes under a little bit of pressure. And obviously that's not all syndications. That's just probably the more publicised ones that I've had a look at from time to time. You know, I think with the difference with listed, obviously it's governed by regulatory bodies. There are active shareholders like ourselves who hold management to task and are regularly challenging them in terms of the decisions they're making. There's good corporate governance, and that is and typically the quality of assets that these listed companies are owning, and the diversified nature of the portfolio rather than a single asset that's syndicated does provide a level of protection for investors, I believe.
Paul, very quickly, just one last thing on the risks in the sector. I know that the South African situation is quite sort of benign at the moment, but are there any risks you see in the global space? I'm thinking about another Dubai or the Asian kind of markets, perhaps getting with inflation coming through and interest rates maybe going up in those places, that people might be defaulting on their properties again. And like in 1998, there was nothing wrong in South Africa, but we had the Asian property crisis that certainly affected us. Is that something very quickly that you think might be looming in the back of the market?
No, I think. Look, obviously there's going to be some short-term volatility, I believe, in capital pricing of REITs globally. But I think fundamentally, the crisis possibly this time around, or the issue we're going into this time around is different. We don't have property companies with huge balance sheet issues. Most of these guys have been recapitalized significantly, so that's not going to be a problem. And at a fundamental level, most markets most of the developed markets that we look at, and here I'm talking about North America, Canada, mainland Europe, and the UK, and obviously we exclude your emerging Europe and Greece and the like. And in Asia, it will be Japan, Australia, Singapore, and Hong Kong. What we find in those markets actually didn't supply stock, both retail, industrial, and office over the last 2-3 years, obviously because demand was very benign. So as a result, we've almost got a bottleneck, and we've had a recovery towards the back end of 2010 in terms of net absorption, and actually we're moving into an environment in some markets where we have limited supply, and that does to a certain extent underpin rental levels when you have got limited supply. Even if demand is not that strong, at least you don't have significant oversupply where landlords, it becomes a really strong tenants market, and you see income streams come under pressure because there's a lot of competition amongst the landlords just to cut rentals to keep their occupancies up. So completely different scenario, I think, to a few years ago. But I think in the short term, capital volatility definitely in repricing, but fundamentals a whole lot better than possibly the last few years.
Fantastic. We have to wrap this up just for now. We're taking a very short break. On the other side of this, we'll be focusing on the Catalyst SA Property Equity Fund, which Paul manages. We'll see you right after this.